In today's video, we're going to be talking about the new stimulus bill and the fact that it allows you to take up to $100,000 from your 401k or retirement plan. What are the rules and should you do it? Coming up next. Hi everybody, my name is Dee Burks and this is Retirement Rescue, where we talk about how to make money, save money, and live well in retirement. Well, today we're going to be talking about the new stimulus bill and the fact that it allows you to take up to $100,000 from your qualified retirement account. Well, let's talk about that. Is that really a good idea? A qualified retirement account means 401k, IRA, some sort of tax-advantaged retirement situation. Now, one thing you have to understand right off the bat is just because the government says you can do it, doesn't mean you can really do it. First of all, there are a lot of rules. Within the stimulus plan, the government really wanted to limit the ability to do this to people who had been significantly adversely affected by the coronavirus. And they gave a list of various factors that they considered to be significant, like you had the virus, someone in your family had the virus, you lost your job because of the virus, you had your hours cut, you lost a business. Those are all great reasons. And then they put in a couple of really murky ones that said things like you had a significant adverse economic impact. Okay, we don't really know what that is. They don't really know what that is. And so there are some of these rules that are going to have to be clarified by the IRS before anybody can do anything. So don't think this is going to be something you can do immediately. It's not. There's a lot of clarification that's going to be needed. One of the other things that they put in this bill was if you take out this $100,000, you have up to 3 years to put that money back in your retirement account and not pay taxes. They're already saying you don't have to pay the penalties. You know, if you're less than 59 and a half, there's a 10% penalty on top of the taxes. Well, they're saying you don't have to pay that penalty at all. And if you put the money back into your retirement account, you also don't have to pay taxes. And that sounds really great. Kind of. But even that part of it, there's going to have to be a significant amount of clarification. When the government or Congress has done anything with retirement accounts in the past, they have limited the issue or the advantage to one tax year. Let me give you an example. When Roth IRAs came out, they allowed people to roll over money from a regular IRA into a Roth IRA, or even a portion of it, if they did it in one tax year, and if they had extra money, not that money they were rolling over, but extra money to pay the taxes on it in that tax year. They limited it to 1 year. When you start carrying over to multiple years, it gets really sticky. And so they limited it to 1 year. Now the implications of paying something back over 3 years are multifold. And so when you're doing something out of your employer plan, normally your employer reports it for that tax year. So if it's going to be spread out over 3 years, and if you put it all back, you don't have to pay taxes at all and no penalty, who's responsible for reporting? They didn't really say. So there are a lot of questions there for employers. They're going to have to get with the IRS. The IRS is going to have to issue some letters of guidance. They're going to have to give some directives. On top of that, most employer plans have additional limitations that they can't just do away with. For example, a lot of employer plans say you can get a loan for a hardship, which is what this is, up to 50% of your account value. Well, if your account's only $70,000, you can't take but $35,000. A lot of those plans also say if you have an existing loan on your 401k, you can't take a second one. Well, what about that? So there are a lot of unanswered questions about how this is going to work And if you are interested in that, you're going to have to really be paying attention and talking to your HR department or talking to your tax accountant about, okay, how are these things going to work before you do them. So the idea that this is going to be quick money you can get to and you can get to a lot of it, that may not be how it plays out. So super caution there. The second part of this is, but should you do it to begin with? And my answer is absolutely no. You should never cash out your retirement account for short-term issues or short-term debt. I just did a video on should you declare bankruptcy. And in that video, I talked about how the fact that your 401k or your qualified investment account, your retirement account, that's a 401k, Roth IRA, IRA, those are the few things that are protected from creditors. Should you have to declare bankruptcy or should you get in a really bad spot financially, that money is protected. The minute you take it out and put it into your account, it's not protected anymore. Because so many of us in the last financial recession, we cashed out those retirement accounts. And guess what? That is why the median, most common account value of retirement accounts for people 50 to 69 is $63,000. Because 10 years ago, we did exactly what they're proposing. The limit was lower. We did it anyway. And look what happened. We don't have anything. So don't be in that situation 10 years from now. One of the biggest problems with retirement accounts and using that money, cashing it out for something, is that people don't understand the opportunity cost of what that money would have done for them had they left it alone. So let's just do some math. Not a fan of math, but let's do some anyway. It's important. Let's say you take $100,000 and you take that money out and you end up not paying it back. Okay, fine, you pay taxes on it. So you are effectively using about $75,000 to $80,000 of that dollars to pay debt, to do whatever. Great, no problem. You're good with that, right? Well, one of the rules we use in financial circles is called the Rule of 72. And basically, the Rule of 72 basically says if you take an amount of money, in this case $100,000, and you take your interest rate and you multiply it by 72, in this case, the stock market has done more or less 10% over the life of the market, 8 to 10%, but let's just say 10% for ease of math. That means that $100,000 will double every 7.2 years. Now, 15 years from now, think about yourself 15 years from now. Maybe you're 35, maybe you're 40. You're in your mid-50s, early 50s. Are you going to be okay with knowing that $100,000 that you used to pay off credit cards and pay off a car, do this, that with, cost you $400,000? Are you going to be okay with that? Knowing your retirement account could be $400,000 more than it is right now? Because that $100,000 every 7.2 years will have doubled. So in 7.2 years, it would have been $200,000. In 7.2 years after that, 14 and a half years, it would have been $400,000. Are you going to be okay with that? Because let me tell you what, you're not going to be. You may think you're okay with it, but 15 years from now, when you're looking at retirement and worried about running out of money, $400,000 is a big deal. You've got to remember that compound interest works for you when you're investing, but it works against you just as dramatically when you take that money out. I did a video not long ago about, are you ready for retirement? And one of the things I talked about was the fact that so many people take a bunch of money out of their retirement accounts the first few years of retirement because they're having fun. They're going and doing, and they're not really thinking about it. But what they're costing themselves long term is that continued growth that money would have made. So when you think about taking money out of your retirement account to use for anything, that's one of the things you have to consider. What is the opportunity cost of that money? And are you going to have significant regrets when it's not there anymore? Because a lot of us do. We really do. If we had just done something different. Now let's talk about the practical matter. If you do decide to take money out, let's say you do take $100,000 out of your IRA. If you're going to pay that money back, and that's your plan, let's say that's your plan. I'm going to pay the money back. I've got 3 years. I can do it. Great. That means you're going to pay $33,000 back into that retirement account every year for the next 3 years while we're in a recession. Is that really practical? Is that really something you can do? That's $2,700 a month. Are you going to be okay with that much money coming out of your paycheck every month? Are you really okay with that? Before you go and do anything like that, you really need to run the numbers. What is practical? Go and talk to a qualified tax person. And I don't mean, Joe Exotic that does taxes in the off season. No. I don't mean your bookkeeper. I don't mean anybody that you think, has a job as an accountant. Nobody like that. Go and talk to an actual CPA. Go and talk to someone who is going to be getting these notices and updates from the IRS. Talk to them about all the factors involved. If things are going south quickly and you think you might need to declare bankruptcy, here's the video on that. Go and talk to a bankruptcy attorney. They'll talk to you for free. Now, the CPA might not, but if you are thinking about costing yourself $400,000, then you need to pay the money to go see the CPA. That's a lot of money, and there are a lot of implications. There are a lot of tax implications, and as those things are decided and made more clear by the IRS, who knows what those implications are going to be. So do not get yourself in a bad way, and go and talk to those professionals now. You can also go and talk to a qualified tax attorney. I don't mean just any attorney. Just like if you have a heart problem, you don't go to just any doctor. You go to a cardiologist. Same is true in the attorney world. If you have a question about how these taxes are going to affect you, go and talk to a qualified tax attorney. Get professional input. Don't just guess at it. Don't listen to the people down at the coffee shop. Don't listen to your mother's hairdresser's sister's brother. No. Go and talk to people who actually know and who are getting good information from the IRS. That will save you so much grief in the long run. You'll know the truth. You'll get it from a professional. And you won't make mistakes that are going to cost you for literally decades. So protect yourself. That's what this video is about. You protect yourself. You protect your retirement. 10 years from now, you will thank your previous self.